Imagine this for a moment. You're watching the news and you hear the same argument again. Inequality is rising. A small group of people control enormous wealth, and the solution sounds simple, almost obvious. Just tax the rich more. At first, it feels like common sense. If wealth is concentrated at the top, then that's where governments should collect more revenue. But the moment you look a little deeper, the situation becomes far more complicated than it seems. Because here's the uncomfortable truth. This isn't a new problem. It's not something that suddenly appeared in the modern economy. Governments have been trying to tax concentrated wealth for thousands of years, and for just as long, the wealthiest individuals have found ways to stay one step ahead of the system. To understand why, it helps to go back in time. Take the Roman Empire, one of the most powerful and organized states in history. Rome built an advanced tax system to fund its armies, infrastructure, and administration. Taxes came from trade, land, and conquered territories. On paper, it looked comprehensive, but in reality, the wealthiest citizens, the elite landowners and political class, often paid far less than you might expect. The reason wasn't complicated. Their wealth didn't exist as simple income. It was tied up in land, estates, and influence. And perhaps more importantly, they had a say in how the rules were written. The people with the most wealth were often the same people shaping tax policy. So while Rome taxed heavily, it didn't always tax where the real wealth actually lived. Fast forward to medieval Europe and you see a similar pattern. Kings constantly needed money to fund wars and maintain power, but taxing the richest members of society, the nobility, was incredibly difficult. These landowners controlled vast territories, collected rents, and even maintained private armies. Their power made them hard to challenge, and as a result, they were often exempt from many taxes. So where did the burden fall instead? On merchants, towns, and ordinary people. Governments didn't always tax where the wealth was. They taxed where it was easiest, and that pattern has a way of repeating itself. By the time you reach 18th century France, the imbalance had become extreme. The country was facing a financial crisis, buried under debt from wars and royal spending. The government needed more revenue, but the wealthiest groups, the nobility and clergy, were largely protected from taxation. Instead, the burden fell on the general population. This wasn't just an economic problem, it was a structural one. The system couldn't reach the wealth it depended on. And when that gap grows too large, the consequences can be dramatic. In this case, it contributed to the conditions that led to the French Revolution. Now, here's where things take an interesting turn. You might assume in the modern world, with advanced financial systems and detailed reporting, taxing wealth should be easier. But in many ways, it's become even harder. The reason comes down to how wealth is structured today. Most people earn money through income, salaries, wages, or business earnings. That income is relatively easy to track and tax. But at the highest levels, wealth doesn't look like that anymore. Instead, it exists mostly as assets, ownership in companies, stocks, investments that increase in value over time. And here's the key detail. Those increases in value are not always taxed immediately. They're typically taxed when the asset is sold. So imagine someone builds a successful company and holds a large share of it. As the company grows, the value of those shares rises. On paper, they might be worth billions, but unless those shares are sold, there's no official income to tax. The wealth exists, but the tax system can't easily access it. And this is where modern finance adds another layer. Instead of selling assets, wealthy individuals can borrow against them. If you own valuable stock, banks are willing to lend you money using those shares as collateral. You get access to cash without selling anything, which means no taxable event is triggered. This strategy is sometimes described in simple terms: buy assets, borrow against them, and avoid selling. It's not illegal, it's built into the structure of the system, but it makes taxation much more complicated because the wealth never fully appears in a form that can be easily taxed. There's also the corporate side of the story. Much of modern wealth is tied to companies rather than individuals directly, and companies are taxed based on profits, not total revenue or market value. That sounds reasonable because businesses need to invest and grow. But when companies become extremely large, this system can produce unexpected results. Take Amazon as an example. For years, the company focused on expansion rather than profit. It reinvested heavily into logistics, technology, and infrastructure. That meant its taxable profits often remained relatively low, even as the company grew into one of the most dominant players in global commerce. At the same time, investors believed in its future growth, and that belief drove up its stock price. As the stock price rose, so did the wealth of its founders and shareholders. But again, much of that wealth existed on paper, tied to valuation rather than realized income. This highlights a deeper issue. Modern wealth is often based on expectations about the future, not just current earnings. And tax systems, by design, tend to focus on realized gains, profits that have already been made. When wealth is tied to future potential, it becomes harder to capture through traditional taxation. Now add globalization into the mix and things become even more complex. In the past, wealth was tied to physical locations. Land, factories, and businesses existed within clear borders. But today, large corporations operate across multiple countries at once. They might produce goods in one place, sell them in another, and record profits somewhere else entirely. This creates a situation where economic activity and taxable income don't always line up. Governments operate within national borders, but capital moves globally. And when money can move faster than regulations can adapt, it becomes much harder to pin down where taxes should be applied. So the challenge of taxing the rich isn't just about raising rates or closing loopholes. It's about understanding how wealth behaves in a modern economy. And modern wealth is fluid. It moves through markets, companies, and financial structures that are constantly evolving. There have been attempts to adapt. Some proposals focus on limiting how much individuals can borrow against assets, forcing more wealth into taxable events. Others suggest adjusting how large corporations are taxed, especially once they reach a certain level of market dominance. But none of these solutions are simple, because every time the system changes, wealth adapts as well. This creates an ongoing cycle. Rules evolve, strategies evolve faster, and the gap between taxation and wealth continues to shift. There's also another factor that quietly shapes this entire process: influence. As wealth grows, it often brings with it a greater ability to shape the rules themselves. This isn't new. It happened in ancient Rome, in medieval Europe, and it continues in different forms today. Power and money tend to reinforce each other. And that brings us back to the original idea. Tax the rich sounds straightforward, but in reality, it's one of the most complex challenges in economics. Not because the intention is unclear, but because the structure of wealth itself keeps changing. History shows a consistent pattern. When wealth becomes concentrated enough, it doesn't just sit still and wait to be taxed. It adapts, it shifts form, it moves across systems, and often it reshapes the very rules designed to capture it. So the real question isn't just whether the rich should be taxed more. It's how a system can be designed to keep up with a form of wealth that is constantly evolving. Because if there's one thing history makes clear, it's this: whenever the gap between wealth and taxation grows too large, it doesn't stay invisible forever. Sooner or later, societies are forced to confront it, and how they respond often shapes the next chapter of economic history.